whatever. After that charming story, I'm gonna go ahead and get us kicked off. Welcome to another agent training. Thanks for joining us, guys. Reminder that we don't have agent training tomorrow. We take Fridays off because we used to do Monday through Friday, and then it just felt like, man, I was maybe hitting y'all a little too hard. So now we do Monday through Thursday, and then we'll do next week Monday through Thursday as well. So I'm actually totally forgetting what the schedule is for Monday, so I'll look that up while Katrina is talking, and I'll let you know at the end of the call. But without further ado, we have Katrina Chapin from GVC Mortgage joining us. I got connected to Katrina via Susan Nemeth. I don't know if you guys have ever used her. She works, well, she's a division of GVC Mortgage under Cafe Lending. She's great. And she was like, I cannot recommend Katrina enough. So Katrina is here to talk us through everything you need to know about lending. So Katrina, take it away.
Well, thank you so much, Rosie. That was a very nice introduction. I'm sure some of you do know Susan, and I'm going to apologize in advance if you hear my emails going crazy. It's that time of day. But Susan is absolutely terrific. She is by far one of the best loan officers I've ever had the pleasure of working with and learning from. I've really taken everything that I've learned from her and implemented it into my system. So I hope to be as efficient as her eventually. She's a machine, and her whole team, they've been working many years to create what they do, and I feel like I am just on the right track. So a little bit about myself, I guess. I started in the mortgage industry about 5 years ago, and I just started in the corporate office at a basic entry-level verification department job where I was calling every single borrower that went through the office and just like, hi, do you know you're buying a house? Awesome. Can you verify this information for me? Great. Congratulations. Have a great closing with your loan officer and your agent, and we'll talk to you again when you refi. From there, I moved on to the lock department where I now lock interest rates, and I get to help other loan officers in the company save deals that might be falling through because of low appraisals or different changes. Just, gosh, anything can happen, I promise. Anything can happen. But I really like being a loan officer just because I get to have that little more personal touch, and I get to do everything the way I see other people not doing it. So I see they messed up here, I make a change in my system. So I know never to make that same mistake that they did. So anyway, enough about me. Let's, I guess, talk about GVC.
Actually, wait, Katrina, can you tell us more about, like, where'd you grow up? Where do you live now?
Yeah,
that kind of stuff.
Take up a whole lot of your time. I know you guys are really busy and going. So we
like to get to know you.
Okay, this is the biggest Zoom call meeting I've ever done like this, so I'm a little nervous. I've done a few smaller ones with like maybe 5 people who are kind of paying attention, but I can see all your lovely faces paying attention and drinking your coffee, so I'm like nervous. But so I was born and raised in Pendleton, Indiana. I still live here now. I went to Pendleton High School. I ran track. My 2nd grade boyfriend ended up becoming my husband, and we're in.
Wait, what?
Yeah.
Your 2nd grade boyfriend?
Yes, we dated in 2nd grade, and then we just kind of fell apart. Like, of course, 2nd grade relationships don't last typically, so we broke up and lived our lives, and then we reconnected about 5 years ago. So we've been dating and now married for 2 years.
That is
living our lives.
Such a great story.
Yeah.
Wow. 2nd grade sweetheart.
Yeah. So he's actually upstairs. He works with me. He's part of my team, and he works at the corporate office. I used to have other processors at the corporate office, but I found that I could get more done if we were working together, because just because the workday ends at 5 doesn't mean we stop talking at 5. So it kind of work drags into the night, but we love working together, and it's just really fun. he has a good people presence too, so people like talking with him. So anyway, it's fun to just bring it back around and keep the business in the family. So we
Katrina,
do have,
what's his name?
his name's Cole, and I have a picture in our little presentation that I'll show you, and he's wonderful. If he did his hair, I'm sure he'd come down and say hi, but you know.
That's amazing. And then you
So,
said you have dogs as well, right?
yeah, we have 2 dogs. We have a boxer American Bulldog, and we have a pit bull American Bulldog mix. They're both white with a brown spot. It's really weird. And we have 2 horses, and we have chickens on the way. So yeah,
Oh my gosh.
we have a little farmstead, and we just live our lives and help people buy houses. So
Katrina, that's so amazing. Thanks for sharing.
yeah. I get my first job started off as a bartender, and then I worked on horse farms, and then I got to the mortgage industry. So here we are. So lots of people, animals in my background. I may not remember your name, but I'll definitely remember your dog's name and what they look like. So if you want to throw them up on the screen at any point, I know somebody was sitting there with their little dog, probably waiting to come on camera. So feel free to pull them up on your lap. That will not bother me. So I guess we'll just go ahead and get into the screen sharing. Just let me know, I guess, when you can see my screen.
I have my 2 dogs right there.
Oh, I have to share it. There we go.
Can you see
There
them?
you go.
Yep,
Yes,
I got 1 thumbs up. Yep, nods, thumbs up. Oh, Rusty, look at that sweet golden. Oh, that made me so happy. Okay, awesome. So, and boom. So this awesome presentation was made by our incredible marketing team. I could never put something like this together. I do have a team of incredible people behind me who not only help me with my marketing, but are more than happy to help you guys with any marketing that you guys would like done, videos, slideshows, print advertising, anything you want. Let me know. We can absolutely help with anything you want in that regard. I do actually love doing my mortgage videos. Last year 2019, we were doing Mortgage Monday videos, and we rolled out about 50 marketing mortgage related videos for home buyers and agents. Those can all be found on my GVC Facebook page if you want to see those, or I'm happy to share them with you, whichever. So GVC Mortgage we are so family focused. They love giving back to the community, and it's crazy and it sounds cliche, but they are always changing the mortgage industry to make things simpler for the borrowers. I actually know the family who owns GVC Mortgage. Their oldest daughter, Carly, was my best friend growing up. So I grew up with them running around, and it seemed like when I started, I already knew half the people that worked in the company because they had worked there for the last 10, 15, 20 years. So the people who work for us, we all get along so well, and they've been there for so long, they know what they're doing. We have people who know how to work around issues and help you get through things. So really family focused. One of my favorite things to do during the year is to help my community is work with United Way. I know every winter it gets cold, it gets drafty in our houses, and one thing that I do with United Way is I will actually go to these houses and help them winterize their homes by putting plastic up, sealing around the windows, anything they need, we do. We come in and help, and it's like a full 12-hour day of us helping our community. Changing the mortgage industry expectations. I see that every day. We see an issue, we figure out a solution, and we make the change and we make it happen. It's what kept our turn times to 14 days in 2020, while most people were working at 30, 45, 60-day turn times. We kept a solid 14-day if our borrowers were willing to get us their documentation that we were asking. no problem. Again, they're just talking about us being family owned, been operating for the last 22 years. They now employ over 220 employees. Again, with a 5 to 10 year turn time, billions of dollars. We actually had our biggest year last year. We broke $1 billion by November. Our company did as a whole. So that was a huge feat for us. I think we ended up doubling our record last year. Just a little bit of the GVC mortgage experience. I know Rosie and I talked about you guys wanting to know what kind of your role and responsibility and what my role and responsibility is throughout the whole process. So we will definitely get to that. But less paperwork. We actually do have a GVC mortgage app, and it allows people to scan their documents to us via just taking their phone and taking a picture. Simple as that. They also can sign all their documentation as far as their initial disclosures, closing disclosure throughout the process. And we were just notified this week that they are working on paperless closings as well. So we will have all digital closings, and they can sign all their closing documents with a click of a button rather than breaking their thumb writing their name 1,000 times. One thing that makes us super special, is our local underwriting. We have a policy at GVC Mortgage where when we submit our loan, the underwriters have 24 hours to get it back to us. So if we submit it on a Wednesday, we will have it back by Friday morning at the absolute latest. 24-hour pre-qualifications. I really hate the word pre-qualification because I don't qualify without documentation. If you get a pre-approval letter from me, I have verified everything that they have told me with their documentation, and I know for a fact that we are good to move forward per the terms that I tell you. Again, 2-week closings, not a problem as long as we have awesome borrowers who stay on top of things and are happy to get me the documentation that the underwriters ask for. One thing Susan taught me was to prepare people the best that I can and ask for things before we even send it. So I try to ask for all the documentation that I think we're going to need before we submit it. And our underwriters usually love our files because they don't have any questions. I've already answered them with all the documentation. Another thing that I really love is that our underwriters have an after-hour hotline that is available to me, because all mortgages are different, all credit scenarios are different, every family is different in what their needs are. There are too many guidelines for one person to remember all of them and all the programs. So if I ever have a one-off question or scenario, I can call my underwriters and I can get an answer within an hour and have it back to you and let you know if we're going to be okay or not. So again, these are all just little tiny things that make us different. But I think it's what makes us so effective and so fast at the process. Another thing is our in-house appraisal department. Most companies use what's called an AMC, an appraisal management company. So their lender has to order the appraisal through the management company. That company has to find a person, get them set up. The company has to come back to the mortgage lender. We eliminate that whole process, that whole middleman. So right now our appraisal turn times are 7 days, which in the industry is unheard of. I know last year in the heat of everything, I was still getting appraisals back within 48 hours, which is mind-blowingly fast. I still can't grasp it. It's so fast. I tell people that and they truly don't believe me. Rate lock options, we do offer extended rate lock options up to 240 days. There are some costs associated with that, but if that's a scenario where your person and I, that's what they want to do, I'll absolutely have a conversation with them up front and lay out, hey, if we locked you in for a 30-day rate versus a 240-day rate, your rate would be much better going 30 days because it's less of a risk. If people ask you about interest rates and why theirs is so higher, the best thing I can tell you is to tell them it's about risk. It's all about the risk associated with your loan. So ask your loan officer for more details about your specific rate. Don't ever feel the need to tell them about rates. I'm always happy to answer any rate questions they have. Again, we have in-house marketing. They're amazing. They get things done super fast and they will not stop until it is beautiful and perfect. Exactly how you want it. We can co-market all you want. Like I said, we can do videos if you have any great ideas. If you get a new listing and you want to do a video tour, because I know most things are digital right now, it might help to have some videos of the house up online just to make them sell even faster. Not that that's an issue. I don't know why that slide is in there. I think I have the wrong slide pulled up. So slide I skipped was supposed to be of me and my husband saying we have more than 6 years of mortgage experience together. And we just love doing what we do. So what does the mortgage experience look like for your home buyers? It looks like home. This is our Mortgage Express app that I briefly spoke about. It'll help them start and manage their application process. They can literally fill out the application online, upload documents easily. You can message back and forth with our team, which I don't use very often just because I think texting, phone calls, emails, so much easier. They can calculate any loan payment and run scenarios. So if I say that they can purchase a house up to 250,000, but they're thinking they want to stay at the 200 range, but you find them a house at that 225 range, right in that sweet spot, they can calculate their loan payments to see how much down payment they'd have to put down to be comfortable with their payment, what interest rate they'd really want to get them exactly where they want to be. And they do receive real-time milestone notifications. So as soon as our underwriter pushes the file back to me, they'll get a notification that they're out of underwriting. Just little things like that so they can stay updated, but I do a really good job of keeping people updated throughout the process, even without that real-time notification. And I think I saved the wrong one. So this rest of this is not going to look very pretty. So you guys know what your roles and responsibilities are. I don't need to tell you what your roles and responsibilities are. You guys are great at negotiating and communicating with us on when they want to buy a house, when they're really interested in making an offer. I think you guys know that every house is different. Property taxes are different. HOA dues are different. So many different things. Is it a condo? Is it a manufactured property? Is it a detached house? Does it have 1 or 2 units? All of those things will make a difference in your person's pre-approval. So it's just really important that you guys communicate with your lenders, whether it be me you're working with or another lender. Communicate with that lender before you make an offer so they can run the scenario through your borrower's file and just make sure that everything is going to go off without a hitch for you guys. You know, we've already done our due diligence up to this point, and to let it fall through on an offer would be so silly. So just let your loan officer know that they want to make an offer on this house and send them the address and the purchase price they're wanting to send to the seller. And we'll run I'll run a scenario for you and your borrower. I'll send them the monthly payment estimate, let them know any extra caveats. If it is a unique scenario, requesting documents as needed to aid the loan officer. It's helpful if you guys will stay on them about it. Did you get Katrina your documents? She said you needed to send this to her, you know, but I will have communicated with them already. And Cole is really, really good about following up with people and staying on top of them to get us that stuff. But again, there's nothing that we should ask that they weren't already prepared for. So as you know, even though you were able to get them under contract, you still have to have an inspection. You still have to have an appraisal. Renegotiations could be required. So that's up to you guys. I have no part of the renegotiation process. Just whatever you guys say is what we move forward with. Any changes to the purchase agreement, I would need all amendments, whether they were countered or accepted. I need all amendments so I know what's going on. And then just to help me get closing scheduled once I give you the green light. I will let you know when our borrower has signed their closing disclosure, and that means that we are good to send or get closing set up and get that scheduled. So my roles and responsibilities include walking the client through loan options, understanding loan guidelines that apply to them in their scenarios, if they'll need to save any reserve funds, or if they need to save more money for their down payment, et cetera, et cetera. I will collect the necessary documents and I will scan everything, and they should not have to give you anything to give to me. Updating clients on additional documents. So again, when the file comes back from underwriting, the underwriter might have questions and they may ask for some more documentation. I do a really good job about telling people, hey, this is what I think we'll need. We're going to send this to the underwriter. They may have questions and they may ask for more documentation. This may not be the last time you send me documentation, just to give them a heads up. I know a lot of people don't get that heads up. So when they do send all that documentation and then their loan officer asks for more documentation, they just feel like we didn't do our job from the beginning. So I do like to warn them of that up front. That way they are totally prepared to have to get more documentation if the underwriter asks for it. Again, I will update not only the clients, but the listing and the selling agent, both, because I think it's really important for all parties to stay on the same page with what's going on. And communicating the next steps. Obviously, I'm going to let you know, hey guys, we're out of underwriting and it's time to go ahead and get the closing scheduled. Can you let me know what that date and time is so I can notify our closer and they can get on the closing docs for the borrower. And I'm going to send you guys this so you guys will be able to, you can have it. You don't have to take a ton of notes or anything. Some of our available loan programs. We do have a ton of available loan programs, and we are always looking to expand our loan programs that we offer if it's going to be beneficial for our borrowers. I could talk about every single one of these, but that would turn this hour-long conversation into 2 or 3 hours. So I'm going to go over some of our basic loan programs like FHA, VA, conventional, USDA. And if you have any questions about these other programs deeper, I'm more than happy to answer any questions that you do have. So the first one is FHA loans. These are typically for first-time home buyers and people who don't have such great credit. Minimum down payment is 3.5%, and the sellers can pay up to 6% in seller concessions. And that is going to be 6% of the 6% of the purchase price they can pay up to. So sometimes we will utilize the FHA loan if your borrower has a great credit score, but maybe they need some more help with closing costs from the seller. We may utilize this program over a conventional just because they allow so much in closing costs. Right now, because of COVID, we do have a minimum score of 640. COVID really rocked the mortgage industry and the servicing side of things. So servicers and Ellie Mae and Ginnie Mae and Freddie Mac, they really reeled back in on all the guidelines across the board, whether it be debt ratios, qualifying credit, non-sufficient funds allowed on your bank statements. They rolled back a lot and they really tightened up. So prior to COVID, we were 620 to 640 FICOs, and we were even granting exceptions for 580 plus credit scores,
Katrina,
which is one of the lowest. Yeah.
Why is that? I think I'm curious because as far as I know, the real estate and the mortgage industry have done really well during COVID.
Yes.
So I'm curious why the rollback or why the tightening of guidelines.
Yeah, and that can be explained because of the amount of people that went out of work and the amount of mortgages that were halting payments. It became a higher risk for the servicers. They weren't getting their payments. They were relying on that monthly mortgage insurance to make the minimum that they can on those. So servicing the loans is what became risky. So they passed that risk onto the mortgages to slow things down. Prior to COVID, I think typical interest rates were around 4.5-ish, depending on the program, borrower, and scenario. Now we are 3%, high 2s, low 3s. So our servicers, they make money by keeping these loans serviced for 30 years, right? Well, these 30-year loans that were purchased last year, they were refinancing into 15-year terms this year or last year. I keep forgetting it's 2021, holy cow. So the servicers of those loans weren't making the money they were expected to make, and it was really hurting them on their side of things. So they restricted their guidelines, and it's impacted us and our borrowers. We are looking to change things and loosen up as the market will allow. So when the refis slow down and purchases pick back up again, I'm sure we'll see a lot of loosening of some of these restricted COVID guidelines. Did that answer your question?
Yeah, that was perfect. That makes a ton of sense. Thanks, Katrina.
USDA loans, excellent loans. What is it?
I think someone just accidentally unmuted themselves. Keep going.
Okay. USDA loans are excellent loans. They do have some fallbacks. They are restricted to rural areas, and there are household income caps. So that really narrows down the people who can buy in USDA homes. So I say household income caps because you don't have to have everyone that lives in the home on the loan. USDA wants to reserve this program for people who truly need it. So they like to use household income. So let's say you have two people who live in the home. One person is going to be on the mortgage, but both people work. We would have to use both of their incomes to make sure they are under that cap. And again, that would be something I would go over with your borrowers from the beginning if they decided that they wanted to look in USDA area. There is a map. If you guys would like for me to send Rosie that link, I'm sure she could easily get you that link. So if you're out shopping with a person who's like, I have to buy in a USDA zone, like I have to go this way because I have zero down payment. Totally fine. I can send you the link to the map. And while you're looking for homes, you can double check the property address with the map to make sure you're staying in the correct zones. And then I can verify that information further if they decide they want to make an offer on that home. Again, it's 100% financing, so there is no down payment required, only closing costs, which could be covered by the seller with the 6% cap on seller paid closing costs. Again, with COVID, we're at a 640 minimum credit score, but prior to that, we were at a 620. Yeah, I think that's really it for that one. Conventional loans, these are more for your higher scoring borrowers or people who want to put 10% or more down on a loan. Minimum down payment is going to be 3%. That's typically reserved for first-time home buyers. The seller can, with conventional loan programs, the seller can only pay up to 3% of closing costs. So that's where I mentioned earlier, we may go with FHA, even if your borrower does have a great credit score, great credit profile, but they need more help with closing costs. We may go with FHA just because the seller can pay more in closing costs. Lots of different private mortgage insurance options. Once your borrower gets to 80% loan to value, they don't have any mortgage insurance. It would fall off automatically or would never be applied to begin with. And VA loans. VA loans are strictly for our veterans, whether it be an active or non-active veteran, whether it be a spouse of a deceased veteran, all of those people would qualify for a VA loan. minimum credit score of 600, and no monthly mortgage insurance. They don't charge monthly mortgage insurance because VA has different rules for different scales of the military, basically. So some people will have to pay a VA funding fee, which is typically a 1% fee added to the loan amount. So it would just be included in the loan amount, and it wouldn't be any extra fee monthly added to their payments, if that makes sense. But a lot of them actually qualify to not have that. It would just depend on their DD 214, whatever that says.
What is
And they
that?
Your borrower would know exactly what that is if they have it. If they don't have it, they likely don't qualify for a VA loan. So we're always looking to expand those guidelines, like I said, as the market allows us to. Again, we can absolutely help you co-market anything you want. I'm not afraid to do videos. If you want a lender in a video with you, we even have somebody who will put scripts together. You give him an idea, he'll put some scripts together, and he will make you look like a rock star. You can have full proof of that in the marketing videos that I have done previously with GVC. Yeah. So did you guys have any questions about anything? I'm sorry, I pulled the wrong PowerPoint presentation up. It was not supposed to be that one. What'd I do?
Katrina, could you talk, you mentioned a little bit about private mortgage insurance, which I think some of our agents know about, but a lot of the agents on this call are actually like brand new agents, just starting to figure out the lending process. So if you could talk a little bit about private mortgage insurance, that would be great.
Private mortgage insurance. So as a lender, I don't want to say it's a scam because it protects the servicer of the loan. It does nothing for your borrower at all. Does not protect them from anything whatsoever. It is a fee that people will pay on a mortgage every month, and it's included in their loan payment. That private mortgage insurance strictly protects the lender from borrower default on monthly mortgage payments. And that is it. It is included on both FHA loans and conventional loans. USDA calls it something different. They call it their USDA guarantee fee. And VA will just charge the VA fee that I mentioned earlier. Conventional is going to have their mortgage insurance is going to cost less because, again, we're dealing with better qualifying borrowers. So they see that as less of a risk. So they make that fee, that percentage of what that fee is going to cost, less than an FHA loan.
That's great. Katrina, can you talk about some of the biggest mistakes you see agents make with you? Is it, I don't know, some things that come to mind for me are maybe like not getting buyers pre-qualified, not getting information to you. Like, what comes to mind for you?
I think you nailed it. That is absolutely it. Not encouraging people to get pre-approved, get pre-qualified. I know a lot of lenders will just tell your borrowers, yep, you're approved, go for it, or nope, you're not, good luck building your credit. I don't think that's the right way to operate. And I highly encourage you to just ask them to talk to me, even if they're maybe interested down the line. You know, maybe their credit isn't good enough right now, but hopefully in a year it will be. Do they have a plan to build their credit? If not, they need to talk to somebody. Every credit report that I pull, I will either inform them on the programs that work for them in their scenario, and we go over everything together, or I will give them some advice on how to build their credit, and I'll let them know about how long I think it would take. I have people that I've been working with for 2 and 3 years who had bad credit, and I've slowly watched it tick up and up and up, and they were ready to purchase, and then COVID hit and our guidelines got tighter. So we had to keep working on it a little bit. But when the COVID guidelines hit, I reached out to all my credit repair borrowers to let them know that things had changed And then it may take a little longer to achieve their goals than what we originally anticipated because of the change in our guidelines. So definitely, I would, if that is one thing you can get through to the people you talk to, is to get pre-approved, get them pre-approved. It costs nothing. It may take an hour or so of their time between the application and getting the documentation pulled from their files or pulled off from online or something, but it is well worth it to know that when they make an offer, you're gonna be good to go. And like you said, yeah.
I was just gonna say, at what stage in the process should someone get pre-approved? Is it like, okay, as soon as possible?
Do not hesitate. Credit reports are good for 120 days, but just because it takes your borrower more than 4 months to find a house, whether it be because they just haven't found their dream home or they've made 30 offers and none of them gotten accepted due to multiple offer situations. If your borrower has a great credit profile, if they're in the 800s, they have low debt to income, there's nothing to worry about. You can shop with them for a year. And then when they're ready to make an offer on something, we can update their credit at that time. And I can just reaffirm that they're still good to go. But yeah, from the get-go, have them get pre-approved. Then you're not wasting your time looking at homes with them that they may not qualify for, or they may not even be in a financial situation where they should be looking at homes. So it's kind of you want to help them look for homes, but you don't want to waste all your time and money driving around, showing them places, looking for homes, talking back and forth with them when you just don't know.
Yeah, that's so good. Any other common mistakes that you would ask realtors to watch out for?
Yeah, definitely. I would not send an offer without sending the address to your loan officer. Absolutely. Because like we said, you just never know what we're going to find on our end. One thing I do double check is to make sure the home isn't in a flood zone. A lot of people don't double check for that, but that's something that I do like to double check for, because I've had that bite me in the butt and I'm never going to let that happen again. I had a manufactured home that part of the garage, the back little corner, was within 100 feet of the flood zone. The home did not qualify. I was able to tell them, don't make an offer on this home because of this reason. We're never going to get financing on it. So just let your loan officer know before you make an offer, and that way they can double check and make sure everything's going to be good for you.
That's great. We just had a great question come in from Eric, which Eric, this makes me think that you want to buy a house. So you got to tell me about that. I need to be in the know. But Eric said, does GBC have any exceptions or workarounds for the 2-year tax return rule for self-employed individuals like realtors?
That is an excellent question. I believe the answer is no with these strict guidelines that we have right now. But one of the amazing things about our underwriting team is if I do have a client where I'm like, let's just see, before you make an offer, let me send your file to underwriting and see what they have to say about your file. We submit them as what we call TBD files, which is a to be determined file. You've not made an offer on an address, but I do have your credit pulled and I have your documentation. I can send that bit of information to our underwriters and they will tell us from there, yes, we can do this, but these are the extra things that you'll need to do to make this happen. So I think the answer is no. I think right now, self-employed borrowers still need a minimum of 2 years taxes.
Yeah, that's great. Yeah, Eric, give me the deets sometime soon. Anyone else have questions for Katrina?
That was a great question, by the way. Excellent question.
Oh, Silva looks like she has a question.
So if you have a client who's wanting to do house hacking, where they're going to be bringing in roommates and having the roommates pay rent that will be helping them with the mortgage, are there any special considerations for that situation?
In that situation, I would ask the borrower first, is this your home? Are you planning on being the only person on this loan? If they are the only person on that loan, we just need to make sure their debt ratios work for them buying the home. I feel like in this situation, a lot of times people are trying to buy maybe a 2-unit home, like a duplex, where they're living on one side and they can rent out the other side to friends, family, whoever else they want. There are, again, more restrictions and guidelines for 2 units. So I'm pretty sure right now they'd have to bring at least 10 or 15% down to buy a dual unit home. But as far as them just renting it out, they would be fine doing that. I'd want them more in a conventional or FHA loan and not a USDA loan. I just wouldn't want them to get in trouble when they go to file their taxes and somehow they figure out that they're making money by renting out a room or something. So I wouldn't have any issues with that. I would just want to make sure that we have all our I's dotted and our T's crossed on something like that. But yeah, no issues renting out just like a single room in a detached property. I have no issues with that.
Cool.
Katrina, this is fun. I'm not technically an agent. Well, I guess technically I am. I don't practice. But one of the things that confuses me the most is like the loan programs for like all the different loan programs. And I'm curious, like, is that something that you would decide as the lender? Like, okay, these people are more FHA or these people are more conventional. Does that just depend on like how much money they have down, their credit score? How does that all work?
Yeah, so if I see that obviously FHA is the way to go for this person, I'm gonna let them know, hey, this is what I see is going to be the absolute best option for you. If they're on the line though, where they're like maybe a 700 score and they're doing a minimum down payment kind of thing, they've got a little extra saved, I will lay out both options. This is the FHA program. This is what it consists of. These are the downfalls of it. This is a conventional first-time homebuyer program with a minimum down payment, and these are the benefits and downfall of it. And I'll let them make the decision from there. But if it's obvious which way they need to go, then I will make that decision for them. But if it's not obvious, I will absolutely let them be the ones to tell me how they want to go. And a lot of people even come in saying, I know I want this program. And that's fine. We'll look at it. And if it makes sense, then we'll just move on with the program that they asked for. But again, if I'm like, we have this program that might make more sense, I'm going to give them that option too, because they definitely deserve to know all the available options that there are for their unique scenario.
Yeah, that's great. Natanya, did you virtually raise your hand? That is the cutest thing I've ever seen.
Oh, I thought that's what you did on Zoom. Cool. Hi.
That's great. Do that more often.
I will.
Everyone take pointers.
Hi there. Hey,
Hi.
My question is there times when you cannot qualify for a specific loan? So for example, I know of a scenario where someone had a flip and they flipped it really fast. Are there any times when, it cannot be FHA, it has to be conventional or vice versa?
The flip is good. Yes, that's a good question, because the seller has to be in possession of the home for at least 90 days is the requirement. So if it is a flip home, you can usually tell because they're usually really pretty. You got the fresh paint on it. You can tell when it's a flipped home. And if I can tell it's a flipped home, I will double check to make sure the previous sale date by pulling the property record card from the municipal auditor's office. But yes, they do have to own the home for 90 days. In regards to your question, I think the biggest issue I see where the one thing that's going to keep them from qualifying for that home, even though they have that program, even though they have a great score, is debt to income ratios. FHA is a little looser on their debt to income ratios. Conventional is a little more buttoned up, a little tighter, because again, the servicers already assume that an FHA loan is a riskier loan. So they're going to have looser guidelines. Rates are going to be a little higher, and allowable credit scores are going to be a little lower. And again, they assume that conventional is a safer product to purchase. So they put less restrictions on them, and they put more restrictions on them, and they require more out of these people. So debt to income is one thing that I definitely see a lot that will either completely stop somebody from buying a home, and that's something that we have to work on for a while, is getting their debt ratios down, or they just won't qualify for a conventional loan because of their debt ratios. I think right now FHA is allowing over 50% on their debt ratios, which is really high. But that will impact the pricing of their interest rate, because again, the servicers see a debt ratio over 50% and they're like, oh my gosh, that's really risky. We're going to insure ourselves a little more. And they do that by increasing the cost of the rate.
Okay.
Yeah, no problem.
Silva, did you raise your hand as well? Wow, is this going to become a trend? I love it.
So I know that if you're self-employed, you have a 2-year tax return thing where they need to show, like, if you're employing yourself, are you good at it? Like, can we trust you making money? If you're employed in a standard, or like what, a W-2, W-4, whatever, what are the guidelines there? Like, I know for us, we did a physician loan and we didn't actually have to be earning income yet. They were able to say, like, okay, we have your contract and we know you're good for it. You made it through med school. Like, congrats on sticking to it. Are there other kind of, like, oh, this person's in sales and they're on commission, like they're employed, but we don't really trust that? Or like, what are some of the different things on that side of things?
That's such a great question. And I love that you brought up the physician loan, and because that is a very unique program that we do offer. And you're right, with physicians and even some typical W-2 jobs, where if you haven't started working there yet, but your employer is willing to write you a letter stating that, you know, John is going to be starting this job on this day and he's going to be making X amount of money, we can absolutely use that letter as your proof of income, because we know you're going to start making that money. Your job vouched for you. That is a very common thing in W-2 employees. We can make that happen all day long, no problem. The only issue I could see with that is if the employer told them they're going to make this amount and then they put on the letter that they're going to be starting at this amount. You know, maybe there's a little discrepancy there, so that might impact our debt ratios.
Okay.
But in the scenario where you have a borrower who's a W-2 employee, so they're making an hourly rate and commission. If they had never made commission before, we wouldn't be able to include that in their qualifying income, but we could absolutely use that hourly income, assuming the boss is willing to state that they are going to work a minimum of X hours every single week.
Okay. For commission that you can take advantage of, do you need 2 years for that, or would like 1 year as a W-2 work?
Correct, 2 years minimum.
Okay.
And that's 2 years filed on your taxes.
Okay.
And one big thing that we do see a lot of with self-employed people is declining income. So where they made 50,000 in 2018, then they made 40,000 in 2019, and then they made 30,000 or they're on par to, you know, make 30,000 in 2020 or something. That is definitely going to hurt their bottom qualifying income dollar amount. And I'm not an underwriter, so in scenarios like this where if I calculate income and I'm just a little unsure of my calculation, I would absolutely send this to our underwriters as a to be determined file for them to verify if this is going to be okay and the numbers that I have are going to work. I do try really hard to work off a worst case scenario, but I never want to work so worst case that they don't qualify. So I definitely utilize that TBD submitted to underwriting to my full advantage, and I'm not afraid to send them all day long. So
Great. Thank you.
yeah.
I will unraise my hand now. Lower hand.
So good.
You guys have had some
Um,
seriously excellent questions. Thank you.
they're a good bunch. Y'all, any final questions before we wrap up? Okay. Katrina, thank you so much.
Yeah, thank you. It was so nice talking with you guys.
Yeah, much appreciated. Guys, for next week, I looked up our schedule. Monday, we're going through Title 101. So that is Cheryl Davis and Laura Paul from First American. Will be walking us through that. Tuesday, we've got an open house panel with 3 agents from the Platt Squad coming to chat. And then the last 2 days next week, Wednesday and Thursday, our very own managing broker, Crystal White, will be walking you through the buyer's process and the listing process. It's going to be amazing. Don't miss it. And that's it. We'll see you around. Have a good one, guys. Bye.
Thank you.
Thanks, Katrina.
Bye.